This, of course, ahead of earnings season in China.
Absolutely, yes. And so while we're still seeing these very, very elevated levels of stress in the offshore market, we have seen these concerns about hidden debt resurface really with a vengeance in January. Looks like that's continuing through February. One of the key focus here, of course, is Logan Group, which has repeatedly denied having certain private debt guarantees, with other media reporting, identifying some of these private debt guarantees. And that has really weighed on the bond prices, but also spilled over into the broader universe of property bonds. And also last month, ahead of earnings, ahead of the first time that property firms are essentially going to open their books since this liquidity crisis began, we saw this spate of resignations from auditors. And the concern is that that may continue to pick up. We may start to see an exodus of auditors ahead of earnings, and that could either lead to delays or indeed could reveal sort of hidden risks that investors previously haven't really been aware about.
What are we expecting in terms of more government measures at this point to try and contain any kind of further fallout?
Well, I think sort of sentiment around that ultimately is rather fragile. Of course, we saw that lifting of loans to some property firms that are focused on affordable and public housing. However, of course, the bulk of private developers won't really benefit that. That is a measure that I think puts kind of the social agenda and the common prosperity agenda at the heart of all of the kind of policy clampdown that we've seen on real estate. Ultimately, this is about making sure that sales and homes are more affordable for the kind of average Chinese citizen. And so if you're a stressed developer, if you're a distressed developer, it isn't really going to help. So rather than this being a signal of easing, we're really seeing this kind of fine-tuning focused around those initial ambitions of this type of campaign.